Aren't we going to have a silver issue in terms of supply here for quite some time as well?
With regards to silver, supply has a lot of merit. The silver price could double. Demand is surprisingly inelastic. The utility generated by silver in germicides, photovoltaic applications is such that until sort of $135 silver, it doesn't make much sense to substitute.
That you're going to take a significant portion of the physical silver proceeds and put it into silver stocks.
Primary silver production, which is the silver production from silver mines, is about 18% of total supply. If you double the price of silver, it wouldn't necessarily increase the supply of silver. Silver comes from copper mines or lead mines or zinc mines. It ignores the massive inventories of silver that aren't in the system, that are held off balance sheet. The other problem that we're going to have is processing capability. The Chinese are the world leaders in rare earth processing technology, a technology that they bought from the Canadians. The Chinese have decided to monetize their metals the same way we monetized our dollars. The incredibly low environmental standards that Chinese rare earths industry has tolerated are going away.
This is it for silver. It's going to come crashing back down like 1980 and 2011. It didn't. It was very resilient. It then made the move higher. Today, it sits between 75 and 80, where there seems to be a new battle taking shape in this zone. On top of that, you're seeing China banning exports without a license. The U.S. is investing in a smelting facility, and other nations are taking some steps around silver as well. There are so many forces behind silver's rise and pressure on silver that it makes me feel like while there's going to be a lot of volatility in the price moving forward, it's going to go a lot higher from here. What's your perspective on silver's move from here, and what are you looking for that could potentially even halt its meteoric rise that we've been watching?
Over the course of the next 10 years, I expect the nominal price of silver to be much higher than it is today. But I will point out to you, Gary, that the success that we've enjoyed in silver makes it a little less attractive than it was. From an arithmetic viewpoint, silver selling at $40 an ounce is precisely twice as attractive as silver selling at $80 an ounce. That's simple math.
The real tension here isn't whether silver rises, it's whether investors are confusing momentum with margin of safety. As Rick Rule frames it early, price resilience doesn't erase valuation risk, especially after silver has already doubled off its lows. China's export licensing and US smelting investments sound bullish, but structurally they raise cost before they expand supply, which historically fuels volatility, not straight-line gains. Silver's long-term thesis may be intact, but forward returns compress when narratives become consensus above key price bands like this. The math doesn't lie, and Rick Rule reminds us that arithmetic eventually overrides emotion.
There was a point in time 3 years ago when I said to people, if you're a speculator, you have to go buy silver. It's hated. It has to go up. When the hate goes away, the price gaps. Well, if you bought silver then, and I did for that reason, you should sell it now. The reason that you own it occurred and went away, and the price realization has occurred. I'm not speculating. Well, that's not true. I haven't sold my silver yet, but I'm gonna. At least that silver that I bought. I've been too old and fat and lazy, and I was out of town. I'm going to speculate in silver stocks. And the silver that I bought for speculation, I'm going to sell. I'm probably going to redeploy half the money back into gold, because although I think silver is a better speculation, I think that gold is a better savings asset, a better piece of insurance. Now, I agree with you on the dimension around the silver narrative. I would just point out that most investors require verification from price action in a market to justify the narrative.
This is what disciplined speculation actually sounds like, not diamond hands bravado. Rick Rule is blunt that the reason for owning silver has already played out, which is something most retail investors never reassess once prices move in their favor. Gold's role here isn't about upside, it's about balance, because historically gold volatility is roughly half that of silver during late cycle metals runs. When investors wait for price confirmation, they often buy after risk has already shifted. Rick Rule is quietly modeling portfolio behavior most people ignore until the drawdown hits.
And the difficulty is that escalation in price demonetizes the narrative. The narrative was at least equally true at $20 and $40 as $80. The difference is that 50%, well, some substantial amount of the benefit has already been sucked out of the market. It's important, I think, at least it's important for me. Every time I make an investment or a speculation, every single time, I write myself a memo, page and a half, why I did it, what my expectations are, what the time frames are, what the three principal risks I see are, and what could cause me to sell, either in the good side or the bad side. I did that with silver. I reread the memo January 1st. And yeah, you know what, pal? You said that you bought this because it was oversold, because it was hated, and that when the hate dissipated, that you would sell it. Guess what?
It's time. All right. So Rick, just to be clear for everybody, you're talking about physical silver,
Yep.
and you're saying that, if I'm hearing you correctly, that you're going to take a significant portion of the physical silver proceeds and put it into silver stocks.
This is the part Wall Street never emphasizes. Narratives don't get stronger as prices rise, they get weaker. Rick Rule exposes how the same fundamentals that justified silver at $20 become fully priced at $80, yet media coverage only intensifies after the move. Writing an exit memo is the opposite of how most investors operate, especially after headlines turn euphoric. The benefit extraction he describes is visible in positioning data, where speculative futures exposure swells late in cycles. Rick Rule is reminding listeners that discipline, not conviction, is what protects capital when stories peak.
And the other portion you're putting into physical gold.
I may put some into silver stocks, but they would be much higher quality. Much higher quality. Certainly physical gold and gold stocks, yes. But what I'm doing in my own portfolio, Gary, and I've been doing this for about 5 months, is I've been moving from alpha, from the most aggressive speculations, into beta. I believe that the beta move is inevitable. And I believe that the beta move in precious metals is going to be pretty extraordinary. And I believe that I can participate in it without taking as much single company risk or single commodity risk as I take on the alpha trade. The other thing, as you know from interviewing me a lot, is I love hate. An asset class that's hated is one that I gravitate to like a moth to light. And silver isn't hated anymore.
No, it's
people
not.
can only think about good things around it. In my private life with my own family, I love to be loved, you know. But when I found in investment markets is that when I'm loved, I've overstayed my welcome. So the other place I'm diverting to very, very, very aggressively is oil and gas.
This shift from alpha to beta is a quiet signal most investors miss during commodity upcycles. Rick Rule is effectively saying the easy money has been made, and now survival matters more than outperformance. Broad exposure reduces single asset blowups, especially when sentiment flips from skepticism to praise, which historically marks late-stage trades. Oil and gas stand out here because capital discipline has capped supply growth despite stable demand, a setup rarely discussed in mainstream coverage. Rick Rule's discomfort with being loved is exactly why this rotation deserves attention going forward.
Rare earths, if there were no geopolitical challenges with China, no. We haven't looked for rare earths, which, by the way, aren't rare, because the Chinese produce them too efficiently. Two things are happening there. The Chinese have decided to monetize their metals the same way we monetized our dollars, which has led to some tension. And the second thing is that the incredibly low environmental standards that the Chinese rare earths industry has tolerated are going away. The Chinese government, the Chinese people are forcing their mining industry to behave responsibly in far western China. What that means is that the pricing umbrella that they've enjoyed, which is partially a consequence of environmental degradation, is going away. So their own costs are rising, and they're rising really, really, really rapidly. Now, we will solve this problem, and we'll solve it in fairly short order. This stuff isn't rare. We haven't found it because we haven't looked for it, and we're looking for it like mad now.
Right.
The rare earth crisis isn't about scarcity. It's about who controlled costs while everyone else looked away. As Rick Rule points out here, China's dominance came from efficiency, built on environmental shortcuts, not geological advantage. Now that those standards are tightening, production costs rise and pricing power shifts, but markets still frame this as a supply shortage instead of a margin shock. Investors should note this transition mirrors what happened in steel and coal after regulatory crackdowns. Rick Rule is signaling that the real risk is mispricing, not missing metals.
The other problem that we're going to have is processing capability. The Chinese are the world leaders in rare earths processing technology, a technology that they bought from the Canadians. We can overcome the Chinese infrastructure lead and technology lead, and we will. And we'll do it quickly. We may not do it with the sponsorship of the Trump administration. I have generally found that government money is the epitome of dumb money. The mining business loves dumb money. But the fact is that private industry will be willing in the rare earths business to do what they're doing in the uranium business, which is to say, enter into long-term fixed price or fixed and floating price contracts with a floor that will incent rare earths. Now, when things like vanadium, titanium, the EMs, which went absolutely crazy as narrative stocks in 2025, those are self-fulfilling prophecies. They were uneconomic at the prices that existed.
Processing, not mining, is the real bottleneck Wall Street barely models correctly. Rick Rule makes it clear that technology gaps close faster than people expect once pricing incentives exist, especially through long-term contracts like those used in uranium since 2022. Government capital often distorts timelines while private contracts enforce discipline and speed. This explains why certain metals suddenly flip from uneconomic to viable without new discoveries. Rick Rule is reminding investors that capital structure matters more than headlines when narratives turn into real cash flow.
They're economic at the prices that exist now, and we don't even need to go find too much. What we need to do is develop the stuff that we've already found that's become newly economic, so that isn't a problem. The problem is in bigger commodities. The problem is in copper. The problem is in oil and gas, despite its current weakness. The problem may even be in uranium, the big markets. Copper, we've underinvested in productive capacity, everybody, including the Chinese, for 30 years. They began to address the problem 10 years ago. We began to address the problem 10 weeks ago. And no matter what we do, Gary, no matter what we do, production in the copper space is in decline. And we can't arrest that decline in 5 years.
Now,
it's estimated that maintaining current production for 5 years will cost between 150 billion and 250 billion. And right now we don't have it. We aren't going to spend it. So we're looking at a 10-year cure.
This is where long-term investors should stop listening to quarterly noise. Rick Rule highlights a brutal math problem. Copper supply can't respond fast enough to meet electrification demand, no matter how optimistic forecasts sound. Even $250 billion only maintains output, not growth, which clashes with EV, grid, and AI power projections through 2035. Oil, gas, and uranium face similar lag effects after decades of underinvestment. Rick Rule is effectively warning that portfolios underweight materials are exposed to a slow-moving but relentless supply squeeze.
To a fairly immediate problem, the same thing occurs to a much lesser extent in the oil and gas business.
Okay.
Go ahead. I'm sorry.
Sorry. So there's two things I want to point out here or ask on what you just stated. The first one being that was not mentioned, and I'm not trying to take this into a geopolitical corner,
right,
and that is China has already proven that in any type of negotiation, they're willing to hold hostage certain metals even if they're abundant out there,
Right.
over us in order to get their way,
Sure.
which means the deeper we go into this cycle, that, this AI war that we're having with them, they could have the inclination to do that at a greater degree if we don't take steps to fix this, which I know we are, but it takes time. It takes time, and then there's the processing angle. The second thing that I'm looking for here in terms of being addressed is with copper declining.
This is the geopolitical risk markets consistently underprice until it's too late. Rick Rule indirectly exposes how supply chains become leverage tools once strategic competition intensifies, especially during technology arms races. China's past restrictions on gallium and germanium show this isn't theoretical, it's precedent. Processing delays mean even abundant metals can become unavailable at critical moments. Rick Rule is pointing toward a future where security of supply matters more than headline reserves, and that changes how investors should evaluate safe commodities.
And some of the other ones also not experiencing a boom, and they're being flat to down production. A lot of that leads to where silver's found, since 70 to 80% is a byproduct of copper, zinc, lead, gold. None of those are experiencing a boom like they did in the 2000s during the China infrastructure boom. So many of them are experiencing down or flat. And so we're not seeing that as an opportunity to see increased silver at a time when we need silver for literally everything, including all Western governments who are trying to update their, military and defense systems to modern warfare. So, aren't we going to have a silver issue in terms of supply here for quite some time as well?
I don't know. Let's be straight there. What you said with regards to silver supply has a lot of merit. The silver price could double. And demand is surprisingly inelastic because the utility generated by silver in germicides and photovoltaic applications is such that until sort of $135 silver, it doesn't make much sense to substitute.
The silver shortage narrative isn't driven by panic. It's driven by structural math most investors ignore. As Rick Rule points out here, silver supply is chained to base metals, and when copper and zinc stall, silver quietly stalls with them. Roughly 70 to 80% of silver comes as a byproduct, while industrial demand keeps expanding through defense, solar, and medical uses, creating a mismatch markets haven't priced correctly. Even a price doubling may not unlock supply if substitution only occurs near $135. What Rick Rule hints at next reframes silver as a policy vulnerability, not just a commodity trade.
And also, as you suggest, primary silver production, which is silver production from silver mines, is about 18% of total supply. So if you double the price of silver, it wouldn't necessarily increase the supply of silver. Silver comes from copper mines or lead mines or zinc mines. That part of what you say is accurate, although it ignores the massive inventories of silver that aren't in the system, that are held off balance sheet, particularly in India, Bangladesh, Pakistan, and Sri Lanka. I remember the decade of the 90s when the silver price went up. And all of a sudden the silver price got crushed, and everybody thought it was the great, the Trilateral Commission or the International Jewish Conspiracy or some mob like that. In fact, it was Indian peasantry. They dishoarded. There's a lot more silver out there.
That's a fair point. Not in
good delivery form.
That's a really good point. But with the Asian circle, including India, Bangladesh, that whole area, looking to raise up 300 to 500 million people over the coming years.
This is where silver bulls often oversimplify supply without understanding cultural liquidity. Rick Rule highlights that only about 18% of silver comes from primary mines, meaning higher prices don't automatically translate into higher output. Yes, large off-balance sheet hoards exist in South Asia, and history shows they can re-enter markets, as they did in the 1990s, but those sales occurred under very different income and trust conditions. With 300 to 500 million people moving up economically, that silver may shift from supply to savings. Rick Rule is setting up a demand transformation most models still ignore.
I know that this is something that you've talked about a lot, that, the poorest of the poor are moving into the consumer class in hundreds of millions of droves. And that means they're going to be buying homes and cars and air conditioning, and all of that requires silver.
Probably more importantly,
and copper.
They've saved in silver. The counter argument to the argument I just made is that as poor people in India and Bangladesh and Pakistan make more money and have savings, it could be that investment demand for silver increases. I know from 40 years of experience with Indian people that as little as I distrust my government, they distrust their government a lot more. And if you give many elements of the Indian peasantry the opportunity to save in a government-run financial institution in rupiah, or burying silver in their backyards, they're going to take door B.
The demand shift here isn't theoretical. It's behavioral and deeply cultural. Rick Rule underscores that hundreds of millions entering the consumer class don't just buy appliances. They buy trust substitutes, and silver is one of them. The World Bank estimates South Asia's middle class could double by the early 2030s, increasing both industrial and savings demand simultaneously. Unlike Western investors, these buyers don't rotate out of metals into equities during rallies. That stickiness changes volatility assumptions. What Rick Rule explains next reframes silver demand as permanent capital, not speculative flow.
The next 10 years are going to be very different than the last 40. The last 40 years, or at least 1982 to 2022, were the most benign economic climate in human history. And the next 10 are going to be much less benign. Purchasing power of the US dollar is, I think, going to decline by 75%. You can accept that and deal with it, or you can be victimized by it. That's your choice. One of the tools to deal with it is the fact that we are in and will continue to be in a precious metals bull market. Precious metals do well when the value of fiat-denominated savings instruments does poorly. Separate and apart from that, we're coming into a materials bull market that has less to do with government fiscal policy and more to do with systemic underinvestment in natural resources. The best way that I can think of, or perhaps the best two ways that I can think of, to deal with deterioration of the purchasing power is to invest in yourself and your skill set so that your earnings increase apace with the deterioration of your purchasing power, and to invest wisely.
This isn't a dramatic forecast. It's a historical reset most portfolios aren't built for. Rick Rule is blunt that the post-1982 era of falling rates and stable purchasing power is over, and the data supports it. Since 2000, the dollar has already lost over 40% of its real value. A projected 75% decline reframes cash as a wasting asset, not safety. Metals benefit not from panic, but from currency decay and capital scarcity after decades of underinvestment. What Rick Rule says next forces investors to rethink defensive allocations entirely.
And there is no statistical doubt that American society, institutions and individuals, are substantially underinvested in gold and substantially underinvested in natural resources. From a statistical viewpoint, the market share of those two sectors is the lowest it's been in the United States since 1982.
The real signal here isn't price, it's positioning. Rick Rule points out that allocations to gold and natural resources are at their lowest share of US markets since 1982, despite record deficits and rising geopolitical risk. Today, metals and materials make up low single-digit percentages of institutional portfolios, while tech dominates over 30%. That imbalance mirrors past cycle inflection points, not market tops. Reversion doesn't require mania, just normalization.